Are we in a artificial intelligence bubble in 2025? And before I start this video, I'm going to tell you a little story that goes back to a previous bubble we had in 1999. There was a company called Cisco. They were effectively, you could say, the hyperscaler of today. Obviously, the business models are a little bit different between Cisco, which sold the hardware for the internet revolution back in the 90s, whereas the hyperscalers today are more so selling the computing power in terms of artificial intelligence. But what Cisco eventually did, because the companies did not have the money back then to buy the equipment, is they utilized something called vendor financing. So Cisco would effectively loan the money to companies in order to buy Cisco equipment. And ultimately this ended badly. We can look to Cisco's past returns. We can look to the dot-com bubble in general. But the reason I'm mentioning this is the fact that this OpenAI and AMD deal, I had kind of figured we might be entering a bit of speculative territory, but this deal it's got to be confirmation of that. We have a company like OpenAI, which is generating around $12 billion in revenue. They're making commitments in the hundreds of billions of dollars to these companies based on, potential future revenue. So we have the AMD deal, which AMD is giving OpenAI equity in order for OpenAI to buy chips from AMD. This has to be one of the most mind-boggling deals we've seen over the last while. It's like, buy our products and we'll give you a 10% stake in the company because you probably don't have money to buy the chips. It's puzzling. And the fact that AMD went up like 25% plus on this news, and I get why it would happen to a certain extent. Obviously, the fact that OpenAI is willing to use AMD's chips is fairly bullish, but the whole equity for revenue deal, it's not exactly the same thing as Cisco was back in the 90s, but it does give that same vibe of the fact that we've hit a moment of heightened speculation in the markets in regards to AI. And in this video, I'm going to go over 3 potential situations that do indicate we are in an AI bubble. Now, I did this in previous videos. I went over 3 signs that the market may be correcting, all data-driven signs, and then I did 3 signs, again, data-driven, that the markets might go higher. I'm going to do the same thing in regards to AI. I'm going to speak today on 3 potential signs that we might be getting way too ahead of ourselves in regards to artificial intelligence, and then probably next week, I'm going to put out a video that kind of highlights the bullish case for AI. Now, which side do I tend to lean on? I tend to lean on this side of things, that we've gotten a bit too far ahead of ourselves, which is why I'm going to put out this video first. And another interesting element here, if we get the S&P 500 to close above 20% this year, this will be 3 consecutive years in a row. This has happened once in history. You can probably guess when it was. And if you're struggling to understand, it was in the 1990s. The markets returned 20% annually from, I believe it was 1996 to 1999, and then it all fell apart. So if we do get a 20% plus close, which considering the markets recently, it's looking like that is likely. This would be only the 2nd time in history it has done so. This is not normal. The situation we are in right now is not normal. If you've been sitting on the sidelines on a lot of these AI names, you might feel a bit silly, but really, I think you're actually correct to kind of sit back and think, has this gotten ahead of itself? If we've looked to previous bubbles, previous high valuation periods, if we understand how simple revisions to earnings can cause substantial valuation multiple compression, along with just the story changing, the narrative changing very quickly. It is a very reasonable strategy to try to avoid a lot of these names. But when we're sitting on social media, we're sitting on X, we're sitting on Facebook, whatever it may be, and we see a lot of these influencers posting, 40, 50, 60% returns, heavily concentrated portfolios, high risk portfolios, we begin to kind of think that we're doing something wrong, when in reality, the long-term strategy that you've deployed is perfectly fine. So a lot of people will start shifting their strategy when the markets are like this. They'll heavily concentrate themselves in names that are ridiculous from a valuation basis. We're talking like 50x plus EV/EBITDA multiples, which have very rarely in history ever worked out to be profitable buys. And I mean, they'll kind of concentrate themselves in these types of holdings. And, historically, during situations like this, if the story doesn't work out, retail often ends up holding the bag on a lot of overvalued companies that get re-rated. The multiples are much lower in the future, and it takes you a very long time to recoup your capital. Now, don't get me wrong. I own plenty of AI names, and I don't plan to sell out of any of them because I have confidence in the long-term returns of those companies, which, by the way, if you do want to see my entire portfolio, we do have a link in the description to hop on premium. We're doing a monthly subscription where you can get your first month for 99 cents. So you can grab that whole platform for under $1. We do this because I am very, very confident you're going to find so much value in that platform once you get in that you're going to stick around. But I am sitting here owning plenty of AI names, acknowledging that we very well could be in a bubble. And my goal here is to not necessarily scare you out of artificial intelligence in this video, but it's more so to make sure that your decisions, if you do decide to go down this route, aren't really based on the fear of missing out or FOMO, which we're seeing a lot in the markets right now. It's going to be some data-driven insights on this current artificial intelligence boom and whether or not these companies are worth it at these prices. So let's dive right into it. And as always, I appreciate the likes, appreciate the subscribes, and drop a comment. Let me know if you think we're in a bubble or not. So the first case I'm going to go over is the obvious long-term revolution, but the lack of a short-term business model, I guess you could say. There is absolutely zero doubt that AI will change the world. The only thing here is how early on are we in this stage? And we can draw a lot of parallels from something like the dot-com bubble in regards to the massive fiber buildouts that were happening during that time. So a lot of these companies who were worth quite a bit of money, they realized that fiber was going to be the future, which it is. Like, fiber was the future. We are utilizing it today at a rapid scale. But what ended up happening is a lot of those fiber companies back in the late 90s, early 2000s, they were simply too early. They dumped a bunch of money into fiber expansion, and a lot of them ended up going bankrupt because what they did, they built out all this infrastructure. Demand was really not that high. They couldn't turn a lot of profits from the buildouts, and the large-scale debt and the large-scale capital expenditures ended up in a lot of these companies going broke. Now, I don't think the hyperscalers are going broke. Don't get me wrong, but the mistiming of capital in this regard, these companies were absolutely right that fiber was going to drive the future in regards to internet, high speed, things like that, but they were simply too early. This was not a situation where they were wrong. They were just too early. During the dot-com bubble, the idea that the internet would revolutionize the world was 100% accurate. But the difficulty here is a lot of stocks were priced as if it was going to happen over the next year or two, when in reality, it took 10, 15 years for a lot of this to materialize. And in this type of situation, the market absolutely thrashed those companies during that era. Now, the key difference here is the idea that a lot of the companies investing heavily in AI these days are very profitable, generate large-scale cash flows, and do have core business models to kind of fall back on if AI profitability does lag. But I think what a lot of investors are underestimating is the amount of impact and the amount of volatility we would see if these companies ended up spending $1 trillion and not necessarily seeing a return from that capital, regardless of the underlying business model they have. If we got into this type of situation, the depreciation would add up on these assets. It would hit earnings. The market would not like it whatsoever. So I think the idea that all this spending is okay, even if profitability lags a bit, because, Alphabet's got its search business, Microsoft has its, software business. I really think that's being overestimated right now. If this ended up being a similar situation where these companies are going to lay the groundwork, the infrastructure for AI, but that benefit doesn't come in terms of profitability for the next 10 or 15 years, the market would punish these companies. There is no question. The key question here is whether or not these hyperscalers, all these companies building out these data centers, will be able to justify that capital spend with profits. And this report right here mentions that in order to satisfy AI-related demand, it will require $500 billion annually in global data center investments. And in order for that to be profitable, they will need about $2 trillion in annual revenues from them to profitably fund them. That is a massive, massive jump compared to today's actual AI-related revenue base, which is still tiny, especially relative to just overall cloud spending. The risk of overspending and overallocating here is immense. There's absolutely no question. If they build out all these data centers and the demand is not there, the pricing power they have from those data centers will fall. The depreciation of these assets will start to hit the income statement, and ultimately earnings will suffer. The main element here is not the idea that you could be wrong about AI just revolutionizing the world. There's no doubt that it will do that in the future. Very little doubt. The idea here, though, is how long will it take to be profitable? How long will it take for these companies to actually realize long-term returns on that capital spend from artificial intelligence buildouts? And I'm going to get more into this in the second portion of the video, which is a very important concept you need to understand about these buildouts and why it might not be as simple as you think. So the second point I want to go over is the fact that there is very strong adoption, but there is very little return at this point in time. I mean, there's a bit of an uncomfortable truth here, and if you don't actually believe this is true, I think you kind of have your head in the sand. I mean, we're seeing a lot of companies adopt artificial intelligence, but very, very few are actually realizing returns from that AI spend. There is studies that highlight that half of employees are now utilizing AI tools. Their company has somehow integrated AI tools into their daily work life. However, the difficulty here is that 95% of organizations are finding they are getting zero returns from AI implementation. And I think this is a situation where Constellation Software actually highlighted this perfectly. We have a lot of AI platforms that are creating a solution and looking for a problem. So Constellation Software rolled out this AI system in one of their companies that allowed people to access data quicker through this AI system. And what they found is they spent all this money because they believed it would be, it would help their workers. So they spent all this money, they set the system up, and they found that it never got used. So in concept, it was an amazing idea. It was going to improve efficiency. It was going to, make workers do things faster, be more efficient, and nobody used it. They spent all this money. Nobody used it because it did not have there was never a problem there. They just created a solution to a problem that did not exist. And this is what you're seeing in the artificial intelligence space at a grand scale right now. There are so many platforms because how do you raise capital quickly and how do you, drive hype? You create some AI system that's supposed to solve this problem that people supposedly have, but the difficulty is nobody has the problem. So you've developed a system that offers a solution to a problem that does not exist, and it becomes very, very difficult to monetize that. And I mean, in some situations, there's been numerous studies that highlight that companies will not pay more for add-on AI tools. So a lot of these companies are having to integrate them for free to kind of keep up with the idea that they need to be developing AI systems in order to, stay relevant. And I mean, the prime case for me would be something like Premiere Pro. This is exactly what you see me editing this video I'm filming right now with. There's a lot of functionality in Premiere Pro that is artificial intelligence related. Now, they haven't really charged anything extra for it right now, but I'll tell you, if they did, I would move somewhere else. I don't really need any of that functionality. A lot of the systems inside Premiere Pro right now are that prime situation of they're looking for a problem. They've created a solution and they're looking for a problem to try and identify it, just to kind of keep up with the fact that they're developing AI products. That's what everybody wants to see right now. And at this moment in time, I mean, every time you enter a prompt on ChatGPT, they are losing money. The industry right now is being subsidized heavily by hyperscalers. Now, there will be two situations where this ends very badly. The first one being the hyperscalers overshoot the potential demand. They build out a ton of infrastructure and the demand just isn't there. The profitability isn't there, and this ends up being a bunch of inefficient capital spent. So yes, the infrastructure is there, but there is just no money to be made from it, at least on a profitability standpoint. I mean, we can look back to those fiber networks back in the dot-com bubble. These companies were right in the fact they needed to build these networks, but they could not make any money off of them. Obviously, fiber is a big deal now, but it wasn't back then, and the market expected it to turn into a big deal very quickly, but it took a very, very long time for it to come to fruition, and a lot of these companies got caught in the crossfire and just did not survive. Now, the second situation would be a lot of these hyperscalers are starting to build out these capital expenditures, and they're starting to realize that they're not driving as high of returns from the AI spend as they had imagined, so they cut back CAPEX. And at this point in time, if these hyperscalers were to cut back CAPEX, it would absolutely kill the supply chain. The suppliers would be decimated. There is absolutely no question. The chip makers, the power providers, the networking companies, they are very, very sensitive to capital expenditure rollouts. So if the hyperscalers do not believe they will make a ton of money off their capital expenditures, they will scale it back, and this will hit suppliers hard. And make no mistake about it, if these hyperscalers, the Amazons, the Oracles, the Googles, the Microsofts of the world do not believe they are making a lot of money off this rollout a year or two from now, they will cut back to spending. The industry right now is heavily, heavily subsidized by a select few players. If there is a weak link in the chain, it poses a massive issue. When we come to capital expenditure rollouts, when we think of actually what it takes to build a data center, the building and the land is probably the longest asset you can depreciate out. I mean, I would imagine it has value for 20 or 30 years, but the difficulty here is it's the cheapest cost to build a data center. When you think of the internal guts, I guess you could say, of the data center, the cooling racks, the GPUs, the networking, all that type of stuff, that is the stuff that costs the most. We're talking, I believe it's 40% of total build out. That technology is going to depreciate much faster. You're probably talking about a 3 to 5 year lifespan. And this is just because the technology will be obsolete because of how fast it is advancing. So profitability needs to come fast, or you're going to see a lot of heavy depreciation on the income statement that is going to hit earnings from these companies. You need the ability to not only build these, but you need the ability to turn profits from them very quickly. Unlike the fiber situation back in the 90s, where the fiber cables, the infrastructure is still kind of used today, a lot of these AI situations, the technology is going to be completely obsolete and will not perform the tasks it needs to in a very short period of time. Now, these companies can use those chips elsewhere. They could probably find another use case for them, but the fact is they're going to be rolling over the technology inside those buildings very quickly, and they need to generate profits from them. And right now, we're not seeing a ton of use case, a ton of profitability, a ton of companies seeing large-scale benefits from artificial intelligence. It just isn't showing up in the data. All right, everybody, quick break from the video. If you do like it, if you do like content like this, head down below, like the video, subscribe to the channel, drop a comment. Let me know if you think we're in an AI bubble or not. I'd love to hear from you, but let's get back to the video with the third and final point. So the third one would be market valuations. And I think this is probably the one that is the most surface level, the easiest to understand. And valuations, primarily on a pure play AI basis, are absolute nosebleed. The market is pricing in profitability from artificial intelligence over the next few years, and we are not guaranteed whatsoever to hit that point. I mean, you have companies like, and I don't want to pick on individual companies, but CoreWeave, they trade at 35x EV/EBITDA, and they're burning through $9 billion worth of cash each year, adding, I believe a few years ago they had $2 billion in debt on the balance sheet, and now they're sitting at 15 plus, pretty close to that. They're trading at absurd valuations. I mean, 35x EV/EBITDA, you are pricing in a boatload of growth into the price. And if that doesn't materialize, you're in a world of hurt. A lot of people might say forward multiples don't look all that bad, but the only thing here is forward multiples are based on sell-side analysts' earnings projections. The sell-side analysts are going to price in near-term AI profitability. The sell-side industry is notorious for being late to the party. They cut well after there's, signs of troubles, and they often are kind of behind in terms of price targets, in terms of earnings multiples, and that is primarily because of sell-side analysts, their kind of incentivization to be more bullish rather than not, because they do a lot of work for these companies in terms of investment banking, in terms of things like that. So it is very rare to see sell-side analysts be bearish until they absolutely have to. So forward multiples are pricing in pretty much perfect execution. So if we do get a situation where artificial intelligence does not deem to be, as profitable in the short term, which if you don't think this is a potential possibility, I would argue you're crazy. This new tech, nobody knows how profitable it'll be over the next 1 year, 2 year, 3 year, 5 year. So if there's a situation where the tech is not as profitable as it, is supposed to be over the short term, you're going to get hit with a double whammy. They're going to revise earnings multiples downwards, and it wouldn't necessarily end there, because a company that is expected to grow earnings at a 30% annual pace will be given a higher multiple by the market than a company that is expected to grow earnings at a 15% pace. So what might end up happening is you will get not only a downgrade in earnings revisions, but you will also get a revaluation by the market. So let's do a simple example of the numbers to highlight how bad this double whammy could be. Let's assume we have a company that is expected to earn $5 in earnings per share next year, and they trade at 30x expected earnings. So they would trade at a share price of $150. These earnings are 30% higher than last year. So they earned around $3.85 prior, and the market expects them to grow earnings by 30%. Let's assume in this situation, AI spending gets rolled back, or, not as profitable as expected. And analysts kind of revise their guidance to 15% growth in earnings per share, which would be around $4.42. So if we assume the same forward multiple, we have a share price of around $132 or a 12% decline. So this seems good on the surface, not really all that bad. But the only difficulty here is the market is not going to pay 30x earnings for a company that is growing at half the rate they were expected to before the revision downwards. There's going to be multiple compression here, and this is where you actually get the heightened drawdown in terms of share price. So let's say the market decides all of a sudden that because this company is only going to grow earnings by 15%, they're going to pay a 20x forward earnings multiple. We then get to a share price of $88, which would be a 42% decline. So you have a 42% decline in share price on a 15% earnings revision. And again, if we go back to something like the dot-com bubble, we had companies that lost 70% of their earnings multiples. And obviously, this is not the same situation because they were a lot more expensive back then. So it's probably a bit heightened, but there were situations where companies were revising earnings guidance by 10 or 20%. And the market was cutting their earnings multiple, expected earnings multiple, by 70%. And what I can guarantee you is the market will not give a shred of lenience towards these companies in the event that depreciation starts to hit the income statement, starts to impact earnings from all this capital expenditure spend, and they aren't earning any profits from this spend. The market will be absolutely brutal on companies like this, just as it has been historically. Now, the added element here that could potentially bring on further drawdowns if we do hit a bubble-like situation is the fact the capital pool is concentrated in so few players. We're talking about the NVIDIAs, the Taiwan Semiconductors, the AMDs of the world, all the hyperscalers. The crowding of all this money means that if sentiment does turn, there's really not anywhere to hide. And in the case of some of these companies spending all of their capital expenditures and then some on this AI build-out, if it does not come to fruition profitability-wise early, the market will punish these stocks. Because the only difficulty here is not only has the profitability not shown up, but the narrative of these AI stocks right now will unwind. There is almost no question about that. When you get to a situation where the narrative starts to unwind, the downside often becomes more amplified. And you also add in the fact that margin debt is at all-time highs. A lot of, the investments made in these companies are coming from margin debt. It becomes even more amplified. Now, again, I do want to reiterate, these stocks are priced to perfection, but perfection can occur. There is a situation where this all works out. AI does become as profitable as imagined in a very short duration of time that is expected to do. And these stocks, the multiples were worth it. There is a situation where that happens, but there's also the reverse situation where we get into a similar situation like back in the tech bubble when the internet was supposed to drive insane returns over the next few years. The narrative was fully intact, and it just took a decade to get there, 10, 15 years to get there instead of 1 or 2. Now, nobody truly understands the potential benefit of AI in the future. Yes, there's a lot of businesses that are not finding any value in it right now, but the tech is advancing so fast that could easily change in the future, very easily. So valuations are high, but these companies could satisfy these multiples if we see the story play out. But if it doesn't, we will likely be in for some large-scale volatility. So just to wrap the video up, and I have some commentary here on a recent Jeff Bezos interview I'll get to in a second, you'd be hard-pressed to find an investor who does not believe that AI will change the world, and I am fully in that boat. The difficulty here is the path to monetization, and we're not talking about mediocre monetization. These companies are not rolling trillions of dollars into artificial intelligence to realize small profits. If that was the case, shareholders would just want the money paid back to them or invested elsewhere. They need to see large-scale returns on this spend, especially from assets that are going to roll over very quickly and need to be replaced. If we have all these hyperscalers rolling out trillions of dollars into artificial intelligence and the story or the narrative does not come true, we have a big problem on our hands. Depreciation will hit these companies hard, earnings will fall or at least flatline or at least not be as high as expected, and multiples will compress. There's almost zero question that would occur in this type of situation. And I think one of the most interesting interviews over the last while has been with a guy like Jeff Bezos. He is a guy who lived through a previous tech bubble, and he kind of mentions the current fever right now as an industrial bubble, not necessarily a technology bubble like the internet was, but an industrial bubble. And he kind of compares this environment to previous tech booms in the fact that there will be many companies today that invest heavily in the tech and probably don't make it. They probably fail. And he had mentioned that, a lot of these companies laid out the infrastructure for the internet and the booming, impact it's had on society in general, but they were just a bit too early. And again, I mentioned that fiber network build out again. Very promising tech that is still used today, but the companies that built it out, they built it out way too early, couldn't realize profits, eventually went broke. He does mention that if the bubble were to burst in this current AI environment, that we should not associate it with the benefit of the underlying technology, which I fully agree with. If the AI bubble does burst today in terms of equity valuations, in terms of the stock market, that doesn't change the fact that AI is a great technology. It just might be the exact same situation from back in the day where it takes a little bit longer to roll out in terms of profitability and in terms of how companies can actually make money from the asset. And he did mention that, back in the dot-com bubble, many companies laid out the foundation of this technology in which society benefited substantially from, but public, equities didn't, companies didn't. So in a nutshell, what he did is he called this a good bubble in the fact that the rollout in terms of capital expenditures and the build out of artificial intelligence is very beneficial from a societal basis. I completely agree with this. Now, is it beneficial on an equity basis, on an individual company basis, whereas shareholders were looking for profitability from these investments? There's been plenty of investments in the world that are beneficial to society, but not necessarily profitable for publicly traded corporations. It's a pretty harsh reminder that technology can ultimately win, but early investors might not. Now, are we there when it comes to artificial intelligence? Obviously, I don't know. If I knew for certain we were in a bubble, I would be in cash right now. I'd be in gold. I'd be in defensive holdings. I'm 100% in equity. I own plenty of stocks that have high exposure to artificial intelligence simply because I do not know. But I also can acknowledge, all of the data I laid out in this video is definitely an issue. There's definitely potential. If you are believing that we might not be in a bubble, you've likely been reading a bit too much bullish commentary. I mean, that doesn't necessarily need to say you need to sell your holdings, but I think it's pretty prudent to acknowledge that the environment right now has become very, very frothy. And I mean, I think more than ever now, risk management is absolutely key. The sizing of positions, the construction of your portfolio. I see a lot of people on social platforms like X, Blossom, Facebook. The concentration of their portfolio in AI names is from a risk perspective, which if you're doing this and you're comfortable with the risk, good on you. But it's crazy. There's a lot of people taking a hyper concentrated risk in a piece of technology that has not proven to be profitable and is in the very early stages. I mean, ultimately, you're responsible for your own portfolio, but in the situation that capital expenditure rollout, it either gets scaled back or deems to be not as profitable, many companies in this area will be crushed, and many companies will probably take a very, very long time to recover. I mean, we do have to remember Amazon, which would have been one of the leaders of the internet boom back in the 90s, they fell 95% after the dot-com bust. It took them, I believe, 9 years to get back to those prices, and it's one of the largest companies in the world right now. I mean, if you own a lot of these AI names, you have to be able to accept the fact that you might realize this type of drawdown. Now, you might be right, and they might continue to go up, but if this type of situation, the bubble-like situation, tends to, become true, there's going to be large-scale drawdowns. So everybody, hope you liked the video. Head down below, like the video, subscribe to the channel, comment down below. Let me know your ideas, your comments, your thoughts on artificial intelligence, market valuations, the use cases, things like that. I love to hear it. And as always, head down below to the description. There's a ton of free resources for you that will help you become a better investor. And if you want to hop on premium, 99 cents for your first month. You get the entire platform for $1. It's crazy. It provides a ton of value, and over 2,000 Canadians are utilizing it right now. And stay tuned for more great investing content.